Just seeing that we've reached the hour, I just want to say hello and welcome everyone to Share's third online religious investor workshop of 2020. We know some people will continue to trickle in the next minute or two, but I just wanted to get things going. My name is Mitchell Anderson, and I'm moderating today. I'm a member of the board for the United Church of Canada's pension plan. My day job is as a United Church of Canada minister, and I also chair the investment committee for the InSpirit Foundation, a small grant-making foundation in Canada focusing on diversity, equity, and inclusion. And so I'm excited today for our discussion about helping me and hopefully all of us here understand how religious and other investors can measure our progress towards investing in ways that are just and sustainable. This video conference will bring together people from more than 50 different investors, religious communities, educational institutions, denominations, pension plans, parishes, endowments of many kinds. And for 90 minutes in both plenary and small groups, we'll explore these important topics of milestones along the way to a sustainable economy. And to help us start off our gathering we are inviting Janet Speth from the Sisters of St. Joseph in Toronto to offer us some words of opening prayer. And so, Janet, when you're ready, I'll invite you to lead us in opening prayer.
Thank you, Mitchell. Hello, everyone. I want to begin with a land acknowledgement. So as we gather today, let us remember that wherever we are on this continent called Turtle Island, we are on holy ground that has been blessed by the generations of Indigenous peoples who inhabited these lands for thousands of years before Europeans arrived. I invite you now to silently name with gratitude the nations of First Peoples in your geographic area. And we'll just take about a few seconds of silence for us to do that. So a prophecy song of the Mississauga of the Credit, which is an Indigenous nation here in the Toronto area, says, "The doorway is open to understanding our shared path. As members of SHARE, we affirm our commitment to building right relationships with our Indigenous neighbors based on accountability, respect, and just coexistence as we learn together to live on and with our home planet Earth." So there is a song called "Draw the Circle Wide," which is beautifully sung on YouTube by Eastminster United Church in Toronto. And it's too long for me to play it today. And I know that I cannot sing it a cappella. So I'm going to just give you the refrain. And the words are very meaningful as we strive for sustainable and inclusive systemic change. So here are the words. Draw the circle wide, draw it wider still. Let this be our song. No one stands alone. Standing side by side, draw the circle wide. So let us pray. Let this refrain encourage us to stretch our hearts to embrace more of this world. Let us understand that the dear neighbor includes human and all beings, and that we are woven in creation. Let us stand in solidarity with all those who are raising their voices to ensure just practices. Let us show more love, more generosity, more mercy, and more openness. And in the words of Simon Ortiz, by working in this manner for the sake of land and people, to be in vital relation with each other, we will have life and it will continue. And so we gather as communities of faith and goodwill. We gather as lovers of creation. May we walk in joy as love calls us on. Amen.
Thank you so much, Janet, for starting us off in a in a good way and for introducing the territory you're from and inviting all of us joining from Indigenous lands to recognize our territories. As an Indigenous person myself, it means a lot to me and I think starts off this conversation well. Today's conversation will unfold in 3 parts. We'll start with introductions, followed by a panel discussion, and ending with a conversation with Anders Thorendal of the Church of Sweden about the Church of Sweden's responsible investment program and the milestones that have guided them on their journey. Now, normally, if we were doing this in person and not all on our screens from our homes and offices, we would introduce ourselves to the people we were sitting at a table. And so to try to replicate this in the world of Zoom, we're going to have shortly virtual table discussions, groups of about 8 or so. So you'll be put over into a breakout group for 8 people. And you'll have the chance to introduce yourself, your institution, and would invite you to share a thought about a responsible investment milestone that either your plan currently uses or that you might use in the future, a responsible investment milestone. And then after about 10 minutes, you'll be returned automatically into the whole meeting and we'll proceed with the next part of our gathering. So during the small groups, your videos will be turned on. But during the panel discussion, we'll invite just the panelists to have their videos on. That helps keep the different people of different wireless strengths or internet strengths, and so that just helps this flow more smoothly for everyone. And so if you do have some trouble with your internet, try turning your video off, and that will just help a little bit with making sure you can listen to our great conversation. So I'll invite our wonderful tech team to move us into our small groups. Well, I hope that was enjoyable for folks. I do just want to apologize. I know some folks were having trouble turning their videos back on in the groups, but I hope that you were able to have a rich conversation with one another. I enjoy the moments of serendipity that can happen. Just at the closing, 2 members of my group, one had previously been the priest at the parish that another was a member of. And so I love moments like that. Those are special. And so thank you everyone for taking that opportunity to have a little bit of conversation and start us off with that. So I just want to mention 2 housekeeping items. So during our panel discussion, you'll have the opportunity to vote in polls on a few key questions. So a little box will pop up and you'll be invited to select an answer. You don't have a lot of time, it's about 10 seconds. So please read, think, and act. And so we're going to start this out with hopefully an easy question to start us off. So I'm a trustee on the United Church of Canada pension plan with assets of a little over $1.5 billion. And I'm also the chair of the investment committee for the Inspired Foundation with assets of about 30 million. And so to help our panelists and others understand the range of funds that we're all attached to, our first question is, how large is your fund? How large is your fund? So our tech geniuses will pop that up. I'm so glad to have such a great team from Share. We'll pop that up shortly and we'll invite you to respond. There it is. And I think pretty soon we should get results. So we'll just wait a few seconds for that and for those to appear. And then we will have the chance just to see. There it is. I can see some results. So most of us come from very small funds, less than 50 million, and with a sprinkling from some larger funds. So that gives us a sense, and our panelists a sense of the sizes of funds that we're talking about, and that there's a good breadth focused on the sort of smaller range of that. So thank you for that. And so there'll be a few more opportunities for those throughout the workshop today. As well, if you have a question for our panel, there's a chat option at the bottom of Zoom. And if you click on that, it looks like a little text bubble. You can type in a question, and I'll do my best to try to get to those and pose those to our panelists as we have time. And so now I'm delighted to introduce our phenomenal panel. Emilie Goodall is Financial System Lead at the World Benchmarking Alliance. The World Benchmarking Alliance develops benchmarks to measure corporate performance against the Sustainable Development Goals. Emilie leads their work on the Alliance on the financial sector, including banks, insurance companies, and investors. Jerome Taraska is the Manager for Capital Markets Engagement at CDP. CDP used to be known as the Carbon Disclosure Project, and it's a global not-for-profit focused on improving corporate disclosure around climate, water, and forests. Jerome works with European institutional investors and on climate change disclosure. My apologies. We also have Sarah Couturier-Tanoh, who is Senior Analyst at Share, a member of Share's team that carries out shareholder engagement on behalf of religious and other investors that represent assets more than 50 billion. Sarah is responsible for shareholder engagement and research related to decent work issues in direct operations and supply chains and corporate lobbying on climate change. I just knocked my headphones out. And so our first question is for Emilie. Emilie, would you tell us a little bit about the World Benchmarking Alliance and its model of change, and where do the Sustainable Development Goals fit in?
All right, thank you so much. Wonderful to be here with you all today. So the World Benchmarking Alliance is an independent organization. It's a non-profit based out of the Netherlands, actually, but operating globally. Our mission is to build a movement to actually measure and incentivize business impact towards hopefully a sustainable future that works for everyone. And as you mentioned, we do this by developing freely accessible benchmarks. So anyone can access those on our website that assess and rank companies on their contribution to the Sustainable Development Goals. Now, there are lots of different ways in which you could go about this, because we're aiming for scale, and I think an acceleration of the changes that are needed given just the urgency of the issues faced. We take what we call a systems lens in our bid to accelerate those changes. So we try and look at whole systems, using the ecosystem thinking from nature and honing in on where they have greatest impact on sustainable development, which can differ depending on the system. So to give you an example, actually next week, we're just about to launch a digital benchmark. So this will highlight the impact of 100 of the world's most influential technology companies. And we took that as an area, as we've seen in the pandemic this year, that has just completely accelerated the development of the technology sector, which was already pretty dominant. If we look at share indices, and we're looking at their impact on digital inclusion specifically, which we see as a critical responsibility of that industry if, in the language of the SDGs, we're to leave no one behind in this technological shift that's going on. Whereas another system that we're looking at, which is food and agriculture, very different. The benchmark there that we're developing, also launching shortly, will look at 350 companies. It's a wider scope that we have, and how they're operating really from farm to fork. And so this will assess 3 key areas where there's the biggest impact in line with the Sustainable Development Goals of the industry, and that's on access to nutrition, on the environmental impacts of the food system, and on the social impact. So how are workers treated in the supply chains, and which is really a key issue also in the industry. And CDP actually is our research partner in terms of how we do this in our decarbonisation and energy benchmark. So I'll leave perhaps Jerome to say a little bit more about how that works in practice. But in general, the idea is that they're intended to act as both carrot and stick for the companies who are benchmarked. Hopefully in a benchmark, if it works appropriately, then nobody wants to be at the bottom and there is a bit of a race to the top. And investors, so that's why and how we think companies can use it, but then we think investors are also users of the benchmark because it can inform allocation or engagement decisions with companies. And in fact, we've worked with, for example, the ICCR's Investor Alliance on Human Rights as a close partner, as a coalition of investors using the data from our corporate human rights benchmark to engage companies where year on year, perhaps they've shown limited progress. So it's a way to engage a wider audience around the benchmark. And then finally, civil society and regulators can also use the insights gathered via the benchmark in holding institutions to account in the same way that consumers also can use the information. And as you mentioned, I'm developing a financial system benchmark now at WBA in recognition of the fact that investors not only have influence on companies' actions, but they also have impact more widely. And so we're aiming to actually assess and rank 400 banks, insurers and companies, asset managers and asset owners on their contributions to sustainable development. And we're in the development phase for that right now. But happy to take any more questions about any of the work that we're doing, and then I'll hand back to you.
Wow, thank you. That's phenomenal. And thank you as well for the framing that about climate change we'll invite Jerome to respond to. At CDP has done a lot of work around corporate disclosure on climate change and carbon, as well, of course, as emerging work on water and forestry. And so before we go to Jerome, I have a question for all of the workshop participants. So we are poll question 2. You'll see it pop up. And this is about Canadian companies disclosing to the CDP standard to get a sense of how many do we think are doing that. And here is our question. So what percentage of the large companies do we think are doing this? And to take our guess, and then we'll see. And then I think Jerome has the answer for us. So when we get those results, I'll invite Jerome to introduce and to speak about CDP's work. Here we are. So most of us think not a lot. And so, and none of us think more than 90%, which is interesting. So Jerome, I'll invite you to speak a little bit of CDP, your work on climate change and science-based targets for companies, and to walk us through a little bit of how Canadian companies here are doing.
Hi, everyone. Very pleased to be here. I'm actually, so I'm seeing you, I'm calling you from Berlin. I'm based in Berlin, but I am French originally. And so very pleased to be invited for this panel today. So I guess you're dying to know the answer of the previous question. And actually the answer is 50%. So today, half of the TSX Composite Index, half of those companies are actually disclosing to the CDP climate questionnaire. So as you can see, it's something that is already widely used, but there's still a lot of work to be done. So what is CDP, the X-Carbon Disclosure Project? And to come back to your question, Michelle, what is the link with the work on science-based targets? I think let's take a step back in CDP's history, and I would say the theory of change behind CDP's work around disclosure. A very simple principle that everybody would understand is you can only manage what you can measure. Based on that, we need more companies to measure their impact, to measure their emissions, to measure their water pollution, to measure their impact on deforestation. And that's what CDP as a non-profit organization is doing, is trying to help companies assess how they impact the environment, but also how they are impacted by the different risks that they are facing due to climate change or due to water security risks or to risk linked to deforestation. So CDP was created as an NGO 20 years ago. We actually celebrate our 20 years anniversary this year. And initially, and as it is today, it's driven by investors, by the investment community. So investors actually group themselves and mandate CDP to collect data on their behalf. And so CDP does this engagement work and collects data for investors on company in a standardized and comparable manner, which allows then investors to use this data in their investment processes and shift their investment flows toward what they think are, best-in-class companies, for example. What was, I would say, a fairly small initiative launched by the UK has turned out to a massive, I would say, global effort. And today, more than 550 investors, banks, asset owners, insurance, pension funds, but also asset managers are asking and asking companies to disclose their data in a standardized manner. And thanks to that, CDP has actually built the largest environmental self-reported database in the world on the corporate side. So companies get to disclose about different things. And as you are well aware, this is a very dynamic field depending on science, regulation, and CDP, that's why CDP has evolved, not only to ask companies, for example, to disclose on climate change and on their emissions, but also to disclose on their water, or I would say water metrics and water governance and strategy related to water risks, but also on deforestation and land use. So this is an example. Another example would be to say that you may be aware of some international standards like the Task Force on Climate-Related Financial Disclosure, called the TCFD, which gives a framework of reporting as well that says what is important is to look at strategy and governance from companies, to look at their risks and opportunities and ask them to disclose on these matters. Ask them to disclose metrics such as gas emission, for example, but also the targets to reduce their emission. And here we say it, targets to reduce emissions. So targets to reduce emissions are one of the actions that companies can take to reduce their impact, but also to reduce the financial risks that they may be facing if they continue business as usual. Now, how do we know that a target, let's say I want to reduce my emissions by that much, how do we know that they are good enough? How do we know they're ambitious enough? And how do we know they're reliable? And the company can be accountable for the targets that they disclose publicly. Well, that's the role of the Science-Based Target Initiative. And the Science-Based Target Initiative was created the same year as the Paris Accords in 2015. It was very much related to this work of getting companies to set ambitious targets in line with science, and that can be a statement from companies to say, well, we set our targets, they have been validated by an independent body, that is the Science-Based Target Initiative, so we can say that they are ambitious enough and they are scientifically, I would say, proved. And this is also a signal to their investors, to the community, to everyone, that they take this matter into their own hands, that they're ambitious, and it allows as well to track their progress towards those targets. It allows to see, okay, have you reduced the emissions in line with the targets you've disclosed? I could go on, but Michel, I'll let you take over.
Well, thank you, Jerome. That's phenomenal, and thank you to people sharing their questions. We'll get to those when we have the opportunity. But first, I'm really excited to hear from Sarah, who's just finished a major project benchmarking the Canadian oil and gas sector around climate lobbying. And so this looked at disclosure, but it was about more than just disclosure. And so Sarah, when you're ready, if you want to share what you discovered and why that's important to investors, please go ahead.
Yeah, sure. Thank you, Michel. So what is disclosed gets measured and gets managed, right? So, there is evidence that an important group of companies, especially in the Canadian oil and gas industries, undermining our ability to meet the Paris Agreement goal. And these companies get involved in political and lobbying activities to push back effective climate regulations through tactics that include financing third-party organizations such as industry associations to do this job, is getting increasingly elaborated, and it's getting harder for investors and the public in general to know how much money they spend on these efforts and what regulations they are pushing back. So this is important for investors. Considering the catastrophic downfall that the failure to meet the Paris targets represent for the environment, the people, and the economy, it is key for investors to hold companies accountable for that and to provide investors with sufficient information to take informed investment decisions. So, it's been years that Share engages the Canadian oil and gas sector to increase the degree of transparency of their political contributions and lobbying activities. Our engagement efforts have been successful as several companies provided more public information on these topics. But at some point, we ask ourselves, how can we move the whole sector, not just one company at a time? So we knew that benchmarks have been proven to be useful as a tool to compare corporate practices, but also as a tool to encourage competition for better practices. Earlier this fall, we released a benchmark, a report that benchmarked 22 companies from the TSX Energy Index and their climate lobbying disclosure. Not surprisingly, the benchmark results were disappointing, as the current state of disclosure in the Canadian oil and gas industry is very poor, despite the fact that all of them, without any exception, participated in lobbying activities either directly or through industry associations. So Now we have a clear overview of corporate disclosure practices. Obviously, we're pushing these companies to provide greater transparency through engagement forums. But you're right, Mitchell, when you're saying that it's not just about disclosure. Transparency is a key element of accountability. And to hold these companies accountable, we need to have more information about how they approach the regulatory aspect of the fight against climate change and how this is aligned with investors' best interests. So we plan to continue engaging these companies to increase the degree of transparency, but also to encourage them to establish proper oversight mechanisms and robust governance framework for lobbying activities. For instance, since 2019, we've seen several of them acknowledged publicly whether they participated or not in lobbying. They clarified what kind of activities they do, improve their disclosure, or establish a more robust oversight. One example I have in mind is one of these companies from the TSX Energy Index that has set up board oversight for political engagement, which is outstanding in this group of companies. Several others have also provided, a comprehensive list of their memberships. And going forward, we expect more companies to progress as well. And we will keep track of it thanks to the benchmark.
Thank you so much, Sarah. And just for folks sharing questions, that's awesome. And I'm keeping track of those. We do want to hear from our panelists just one more time before we get to some of those. But if they've been following along and are able to incorporate responses, that'll be excellent. So Emilie, we'll turn to you next. And so at the World Benchmarking Alliance, you've been looking closely, of course, at the financial sector, including funds like those connected to the participants at today's workshop. And investors' expectations are growing on looking at all kinds of different systemic risks, not just climate change, but also inequality, regulatory structures, asset manager accountability, both at the asset manager level and for individual companies. And so here I might invite you, if you're able to respond to the one question about how there's sort of a proliferation of benchmarks, but how are you advising and guiding asset managers? What guidance are you giving them on how to navigate this?
Thank you for the question, and I will address that great question in the chat about, it can be quite difficult to navigate the way through what looks like seems to be an explosion of sort of disclosure approaches and rankings and ratings and indices in this area. But just quickly to answer your question, Mitchell, first, I think we're not giving guidance per se to asset managers or asset owners, but I suppose in a way, indeed, the methodology that we'll develop next year around the benchmark hopefully will act as guidance. We're not seeking to provide that directly, but I think the methodology itself hopefully will give a good indication of where there are perhaps increasing societal expectations, because we develop our methodology through quite broad consultative processes. As our name suggests, we're an alliance of over 170 both public, private and civil society organizations, including Share. And all of those actors help come together as we develop our methodologies, help input, but also act as users of those initiatives. So we try and reflect a little bit the zeitgeist, I suppose, on expectations of companies, which are rapidly changing in today's world. It's a real challenge for companies and I think leaders of financial institutions to really keep abreast of that, what's increasingly known as dynamic materiality. And I think that takes me to the answer to the proliferation of standards. I think, yes, there is movement in reaching uniformity or trying to move towards some comparability, to Jerome's point, which is really critical if we're to hold, for financial institutions to assess their own performance, companies to assess performance, but also outsiders to hold those institutions to account. In fact, you might have seen the announcement today that's two of the big ones emerging. SASB is taking on the Integrated Reporting Council, IRC, and I don't think that's the last merger that we're going to see in this space, and I do take that as a positive sign. But maybe three things I'd share to help distinguish perhaps between some of these initiatives to help as you navigate the space. I think the first is to distinguish between reporting frameworks, whether general frameworks that help companies and financial institutions assess materiality, like SASB or GRI, versus those that are issue specific, like CDP, which then goes much more detailed comparability tools. And forgive me, Jerome, if I'm not quite using the exact right language for CDP, but on climate, therefore, or there are others on biodiversity loss that are emerging, so become very issue specific. And then I think then there's those general frameworks, specific or general. Then you have the benchmarks, the rankings, the ratings, the indices that build on those. So they're distinct. You have, the reporting framework and then the assessment process essentially that use those. And I think you also see a distinction. The second area I'd say is those that assess risk to portfolio. So are using the lens perhaps of responsible investment or ESG language to assess financially material risk versus those that are looking at the impact of those of the portfolio. So it's a different lens. Is it just looking, is this going to affect my financial returns, or actually does this company affect people and planet? And sometimes they overlap and sometimes they don't. But some of those initiatives are looking at one and some of those initiatives are looking at the other. And then the final thing I would say, and this speaks to Jerome's point around the Science-Based Targets Initiative, is for that subset that are looking at impact, and as you can see, this filters down, you start to get fewer and fewer initiatives that do that. Then there's a very small group actually of initiatives that, like the Science-Based Targets Initiative, I would say, that are not only assessing impact on people and planets in a sort of relativistic or incrementalist way perhaps, but is actually looking at what's the actual need? What does the planet need? Actually, we all need to move towards a net zero position. And therefore, what's the denominator, so to speak, in that assessment? And there's actually, when you drill down, there are far fewer initiatives in the market that are really looking through that lens. So if that's something that you're really interested in as investors, then I would, when engaging with intermediaries, then maybe look to, are they talking about initiatives in that latter category?
Excellent. Thank you for responding to a number of concepts there, Emilie. I think that's helpful. And Jerome, I want to thank you for your very thoughtful written response to one of the questions in the chat. And I'll go to you next. Returning to science-based targets, leaping off of what Emilie was just talking about, and how these are important to investors, and how carbon reduction or greenhouse gas reduction relates to evaluating whether or not something's a good investment. Well, of course, we're values-based investors here. We are investors too. And so how do we marry those two things together?
Absolutely. Thanks, Mitchell, for your question. Indeed, as a responsible investor, it's I would say there's no duality between performance and a responsible investment. It's actually a misconception. It's actually to protect your investment that you probably take into account certain considerations. Regarding climate and regarding greenhouse gas emissions, why is it important for an asset owner to look at companies with good targets, with ambitious targets, and that are really active in reducing their emissions? Well, let's say this way: what if stock prices, and I would say companies that you invest in, were actually missing something? What if there were some elements that were not taken into account when actually evaluating the future cash flow of a company, the main methods to evaluate the value of a company? Well, that is what's happening. We are missing something currently. It's called, actually in other terms, it's sometimes referred to as the carbon bubble, meaning that there are companies that rely, a lot of industry that rely on the exploitation of fossil fuel. But if we do want to achieve the Paris Agreement and limit global warming to at least 2 degrees, there's a scientific study that looked at the fact that most of fossil fuels would need to stay in the ground. Now, what would happen if companies who rely on exploitation of these resources could actually not be able to exploit these resources because we don't want to warm the earth? And that's the challenge we're facing today. The carbon is not priced in most companies. They sometimes have an internal pricing, something we encourage, but their stock prices does not reflect this point. And if there were in some parts of the world some regulation asking companies to price the carbon, then some companies would be heavily impacted on their future cash flow. And so the valuation would drastically drop, with the consequences of potential financial crisis or economical crisis. You as an investor, of course, you know better. You know that there are some, this externality of carbon risks. need to be internalized, needs to be considered when identifying good investments. So that's why CDP has co-funded alongside the United Nations Global Compact, as well as the World Resources Institute and the WWF organization, the Science Based Targets Initiative. It's a conglomerate of four organizations that try to put forward this agenda of saying, let's help companies set ambitious targets, because once they have committed publicly that they will reduce emissions, they will have to find a solution to do that, to follow through, to follow suit. And so that's really this theory of change that we try to push at CDP, is not necessarily to push investors to only invest in green energy, but as I've heard in one of our previous workshops, I think it was Elizabeth who was saying, we want to continue hold stocks that are depending on fossil fuel, because we want to influence them. You have voting rights, you can engage with them, and that's what you're doing with Share. And so that's a theory of change too. We think that if we want to reach the Paris Agreement, we need to get the most polluting sectors and get them to transition, to transform, to reduce their emission. Of course, CDP's work is not only on emissions, but also, as you have rightly said, Michelle, also on water and deforestation. And these topics are linked. Basically, all the environmental risks that could influence the company's performance, we call that materiality. Those risks that could potentially influence the financial performance of a company. Well, so on the climate aspect, pushing companies to set targets, ambitious targets, and reduce their emissions in line with those targets are a way to get out of this crisis and be active. And according to us, this is one of the strongest climate action that a company can take on the environment or climate side. Science-based targets are really important. I think more and more we see in the world, in the investment world, that investors actually have a look at science-based targets and companies that set a science-based target, because they are a bit more future-proof, but it's still too little. To give you an example, 500 companies in the world have set a science-based target today. 1,000 are in the pipe of getting their targets approved, but it's still too little. So what CDP has done to actually get more companies to set science-based target, CDP has launched this summer, actually very recently, for the investors that are actually already working with CDP and asking companies to disclose. Well, they gave them the option to also sign the letters that will be sent to the 1,800 companies that are the most emitters, asking them in these letters signed by investors to set a science-based target. So an example of collaborative engagement that can be done. We encourage investors as well to, if they have dialogues with companies, to ask companies to reduce their emission, and why not set a science-based targets. So we want to encourage this I would say this dynamism and climate action. I would also mention that the good thing and the interesting thing about science-based targets is that it's good for companies themselves. What companies say when after setting a science-based target is that it's good for their reputation, it's good for their business, it's good to protect their business of the potential climate risks. So companies use this as a tool as well to change and adapt their strategy. Then it's used by investors to actually identify companies that are leading the transition. It's used by policymakers, and that's why it's a key component and I would say an important component of CDP disclosure as a whole. The data collected by CDP, whether it's on risks and opportunities, on strategy and governance, on emissions, on targets, can be used by a multitude of actors. And we have Emilie in the call today who mentioned it rightly, that there are many tools, many actors that can, make use of this data and integrate it in their own processes and build more tools that will help us actually achieve the Paris Agreement.
Amazing. So just a couple things for folks so we know where we're going. There's just a flurry of wonderful questions coming. I know we're dealing with some of those again through text, which is awesome. Jerome, there's one that's really pointed to follow up on something you raised. Peter asks about that carbon bubble you spoke of in asset prices. And could that lead to market volatility when governments create policy responses? So is that a question that investors should be asking around potential future market volatility related to that carbon bubble idea?
Yes, I mean it's always this difficult compromise, and I think hearing insurance companies as well talking about this topic is always informative, because obviously if you don't do anything, your physical risk, the risk of acute critical disasters and sea rise levels, so like really physical disaster and catastrophes, happen more and more. If you do something too, I would say, abruptly, and now the risk is that companies lose a lot of value. There is a financial crisis, economical crisis with social consequences we can imagine. So it's a fine line indeed of finding the right response that can, encourage companies to do their transition, prepare in order not to have physical risks that are too late to control, but not, push, companies to default and create financial crisis. So it is indeed a fine line. And so that's why as well, the line we're taking is we asking companies as well to take their responsibilities, investors to take their responsibilities and help companies, push companies to tell them, look, you can already set an internal carbon pricing. We will use this data. We will be interested in seeing actually what internal price of carbon do you use and how I should, discount your future cash flow based on this. So that is an example of question that is present in the CDP questionnaire. So yes, there is policy that is required by governments, but of course they cannot be too abrupt, because it would be wrongly taken by industry and actually sometimes be counterproductive for the society.
Okay. Thank you, Jerome. So I just want to hear from Sarah one more time and then we'll have a fair bit of time to deal with some of the questions you're asking. So please keep those coming in. But Sarah, I want to invite you to connect this with Share's work. Many of us here are clients of Share, and to look at how benchmarking disclosure informs Share's corporate engagement work. And perhaps if you want to speak to some of the corporate human rights work and benchmarking work that you've engaged with.
Yes, sure. So at Share, we engage companies on a broad range of ESG topics, including climate change, water, climate well-being, decent work, and human rights. And when we engage a company on any of these topics, we need to conduct some research beforehand to understand better where the company stands. Is it a laggard? Is it a leader? What are the best practices and where are the gaps? So we can identify where we should focus our engagement and what we want to achieve. We often use external benchmark to complement our research. For instance, in my work, the Corporate Human Rights Benchmark, the CHRB, is an excellent tool to support our engagement, our shareholder engagement. It provides us with a comprehensive view of a company's performance in several areas of human rights due diligence and compare selected companies by sector. For instance, this past years, we have engaged several companies, including fast retailing or Gildan activewear, on their effort to uphold decent work practices across their supply chain by implementing more robust human rights due diligence, including grievance mechanisms. So the CHRB really helped us to have more clarity on what we can reasonably expect from such companies, whether it is about taking action or providing better disclosure. We use other benchmarks too. For example, we also rely a lot on the chain benchmark. It has informed our engagement with Gildan Activewear, the apparel company. So during our communication with the company told us that it clearly monitored its benchmark performance and used it to improve its disclosure and practices. And since we're engaged, the company uses to benchmark to improve, and it committed to increase the level of transparency, including a list of suppliers that would cover 97% of its total revenue. So that's really good. And when it comes to the CDP, there's also a lot of interesting information about companies' engagement with policymakers that we can actually access through the platform. For instance, Suncor is a company that acknowledged in the CDP response that it has identified misalignment with CAP. And this is a key information that helps us to better understand where the company stands, because it does not specify this information in any other of its documentation.
Excellent, thank you. Thank you, Sarah. I'm going to turn now to try to invite the panelists to respond to a couple of the questions we've seen in the chat. Both Joel and Margaret ask a question around consistency and rigor and verifiability. Really, how do we as religious investors trust some of these things out there in the marketplace? Trust that companies are telling the truth. Trust that they're telling us what we need. How do we gain confidence in some of these tools? And so, Emilie, perhaps I'll invite you to engage with that question first off.
Sure, thank you. So I think it's a really important question indeed, where to trust, I think they're connected with the proliferation of what seem to be standards and frameworks. I think, there's a risk here, of course, that this growth and then not understanding the verification behind that, or lack of, can really risk undermining any trust in the industry, and certainly in the development of responsible investment practices. I think I have to say, as WBA, we really are trying to incentivize through the benchmarks public disclosure. So I think in some ways, we're trying to, by using information that the institutions themselves have placed in the public domain, we are assuming that they have gone through some form of verification process of assurance, because it's clear that we're then using that information in our ranking and our rating. Of course, there's different quality of information put out by institutions, and I think that's the idea of why we're trying to incentivize the public nature of that. As they say, sunlight is often the best disinfectant, rather than relying too much on information that's provided through questionnaires, although there's always a role for that, as Jerome is explaining, where there's just, and Sarah just indicated, there are still so many areas where companies are not disclosing this information. So I think the really key building block in this space is to encourage standardized, comparable reporting in line with industry frameworks, as opposed to, I think a lot of what we've seen in the industry to date has been what I call sort of internally defined sustainability measures. So it's just a bit better than what we did before, or it's a bit better than our nearest competitor. And I think we're moving into a space now where that's just not good enough anymore. It's not good enough for the needs of people and planet, and it's not good enough from an investor needs, Christian, in terms of understanding the materiality, the risk posed, and then the comparability for performance questions. So I think the more that these frameworks can develop more standardized, as I mentioned before, denominators, so what are we actually measuring progress against, then that hopefully can also increase the consistency, and then you get, rather than lots and lots of noise, perhaps more reduced disclosure information, but of a higher quality in line with things that really matter.
Jerome, I'll invite you to tackle that too, if there's anything sort of from your hat that you want to add around this trust and verifiability.
And I totally agree first with what Emilie said. I would add that first of all, when you are actually, for example, a CDP signatory, an investor signatory, you do access the type of verification documents provided by companies, so you can judge. Now, I understand it may not be easy to judge the rigor and objectivity of such an audit, but that's already a first step when an independent provider provides this audit. we do expect that auditing might come in the environment, and is already happening actually. That's an example. Auditing greenhouse gas emissions is already happening. It's one of the questions in the CDP climate questionnaire. And what is the difficulty here is that auditing financial figures costs something. And so, auditing widely the self-reported data would, maybe give additional guarantees, but would also potentially increase the cost of the environmental data that then needs to be accessed by investors to make decisions. So it's, I think it will come, and I think it's also somehow a consequence of this could be that the environmental data that you use may rise in price. So that's something as well to consider. Finally, as of today, what is important to relativize the issue, you have some help. Actually, there are some resources that help you actually better understand what are good disclosures. And as Emilie mentioned rightly, there's different way to compare to peers, to do sectoral averages, thanks to what other companies have disclosed. There is a PCAF that is also giving some, I would say, guidelines as how to disclose carbon data. And the Science Based Target Initiative is another form of auditing and independent auditing, because before your target is validated, they ensure that your targets covers most of your emissions. So they first look at your emissions. So these are, different mechanisms that also, help trust the data. And I would say, to conclude this very important question about, how to trust companies, I would say that what is important is to understand who is behind the reported data, whose responsibility is engaged. The questionnaire signed by the CEO, by the board, who is really responsible for those answers. And at the end of the day, what is important is that companies do this reporting, because by doing this disclosure effort, they transform, and it's a tool for their transformation. And it's very legitimate to have critique and reserves regarding self-reported data, but I would say it also brings tremendous impact, and so that's not to be forgotten.
One thing I've heard from each of our panelists in different ways, and this connects with the questions around the proliferation of standards and benchmarks and around the ability to trust them, is that it may be that what we really need might be fewer things that matter more, and that might be where we need to focus our attention. And so, in financial terms, we think about materiality all the time, and it's harder to adapt materiality in when looking at people or planet, but it certainly is a useful framework for thinking about. And so perhaps I might invite each of our panelists sort of 60 seconds or so in thinking of that materiality and how that might help us as religious investors in those milestones toward a sustainable economy. How might we incorporate that concept, that theme into our work? And Jerome, maybe I'll lead off with you in thinking of materiality, and then I'll turn to both Sarah and Emilie.
Yeah, I'll try to be very short. I would start by saying, defining materiality, there are two definitions actually in the market today. Is it how the environment is impacted by the company? And in that sense, that could be material when the company releases polluted waters, but also how the company is itself impacted by climate change, by the risk posed to. So we actually talk sometimes about double materiality, so we can take both things into account. And I think what CDP is trying, and I think not only SASB, I saw that SASB was mentioned earlier, it's also looking at this materiality analysis and relying on experts to tell us, well, we know that this sector is releasing a lot, for example, of polluted water, or it's very dependent on rivers to actually cool down their factories. And so that has an impact on the environment. So we can also rely on community of scientists, of experts, to tell us, well, we know that some sectors are more material to certain topic than others.
Thank you, Jerome. And Emilie, similar question, thinking of that measuring what really matters. How does that inform your work, and what advice might you have for us as investors?
Indeed, I think there's a challenge in this space in that absent global goals, sometimes you do have the issue of impact being in the eye of the beholder. It can be sometimes subjective, and what matters to one person or institution may be valued very differently by another. But I think we're facing increasing recognition in the market of science-based issues, science-based global goals. And I think that's where you're seeing that feed through into posing systemic risk in a really serious way to financial markets, regardless of what your values or your desired impact may be. And I think, we've had recognition of climate change as posing systemic risk by the Fed, by the FSB today. Biodiversity loss, I think, is not far behind. And then you've got rising economic inequality, which has just been laid bare by the pandemic this year, but has been an issue that we've been facing for some time. And I think if you take those three pretty sizable challenges, then I think there's, regardless of whether it's single or double materiality, it sort of boomerangs back one to the other across each of those three. So I think there's a role here for institutional investors to seek to engage with the investment chain, whether it's the asset managers, consultants, or directly with companies, to really understand how are institutions tackling those three issues. What commitments have they made? What acknowledgement first and actually they have? What commitments are made? And then what progress is there? What progress is being made across that portfolio?
Thank you. And Sarah, thinking from Share's perspective, someone who helps us directly, a lot of the investors here on this call, thinking through this question of materiality, any advice you have for us today?
Yeah, so first of all, I don't really believe that financial and extra financial performance have to be exclusive. There are both relevant and meaningful for most of investors, and we can pay attention to them holistically. Obviously, each asset manager or investor has its own way to incorporate sustainability issues into their portfolio management and decision-making process, but ultimately, when a societal issue may have important adverse impact on a company performance, operation, reputation, there is much more consensus on the fact that this issue needs to be addressed. For instance, in 2019 and 2020, Share filed a shareholder resolution on behalf of the Atkinson Foundation at Restaurant Brands International. So this fast food company owns Burger King and other brands. It relies on a large number of precarious workers, frontline workers, which the vast majority are employed through its franchise network. So the proposal asks that the company provide some more information about how it manages its workforce, but also asks that the company provide key workforce metrics. So the first year we filed, the resolution got approximately 60% of independent shareholder support. After the vote, the company refused to address the substance of the resolution. So we filed the next year. It's the very same proposal, same language. So 83% of independent shareholders voted in favor of the resolution. So such a high voting result clearly indicates that investors across the board related to the proposal based on their own perception of sustainability and risk. So, and actually including those that would usually follow management recommendation.
So taking a risk-based lens, that's important about what are, and that risk is both financial and non-financial, and those both impact ultimately investment performance. I'm just blown away by the talent of our three experts on this panel. I just want to thank each of you so much for everything you've offered. I've learned a lot, and I'm confident everyone here in the workshop today has taken a lot. So thank you so much. If folks want to say thank you in the chat, I'm sure that'd be well received, that we've been so lucky to have Sarah, Emilie, and Jerome. So thank you so much. And we're closing this part of our workshop and moving to our last section, which is a conversation between Share's Chief Strategy Officer, Shannon Rohan, and Anders Thorendal, the Chief Investment Officer for the Church of Sweden. The Church of Sweden has a long track record of commitment to investing in alignment with its faith beliefs and commitments. And so to help Anders understand Canadian practice and Canadian religious investors, we have a final poll question for you. And this is about our own practices. So the poll question will come up right away. And this is about what practices do your fund use directly or through service providers in your work for responsible investment. So that's popped up. Please fill it out. You can select more than one. So select all that apply. And this will help Anders and all of us get a little sense of where we're at as a group of religious investors. So results from that should be popping up very, very shortly here. And I'm really excited to see them. I'm curious. So I'll just wait for those to appear. And Anders and Shannon will be getting ready for their conversation. Here we are. So many of us use negative screens. A lot use ESG integration. Majority, but getting a little smaller, use shareholder engagement. And a sizable minority of us use thematic or impact investing in specific themes. Very interesting. And I'm certain that Anders will have a lot to share from their perspective. And so I'll invite Shannon and Anders to lead us off in your conversation.
Great, thank you so much, Mitchell. And I want to thank the panel, Sarah, Jerome, and Emilie, for your really informative and interesting contributions in this space. So that's a great way to lead into a conversation. And it's a real pleasure for me to have the opportunity to be in conversation today with Anders Thorendal, who is the Chief Investment Officer with the Church of Sweden. So thank you so much, Anders, for taking the time to join us today. I know it's evening your time, so we really appreciate you contributing your time and your expertise to this conversation. Perhaps just to start, Anders, you could give us a bit of the bigger picture and tell us more about the Church of Sweden's investments, including the size of your portfolio, your overall approach, your use of investment management, and the portfolio's financial success.
Sure. Thank you very much, and thank you, Mitchell, and for a great panel. Very interesting, and thank you for inviting me. So I will do my best to give you some insights into what we have been doing for quite some time at the Church of Sweden. So just give you a short background. The Church of Sweden is the Lutheran Church of Sweden. It was part of the state actually until the year 2000. And I guess that's why we still have some 6 million members out of a population of 10 million people. So it's quite it's by far the largest membership organization in Sweden. And we are organized on 3 different levels. The national level that I represent. We're also on regional levels and local levels, with of course their parishes. And for your information, Church of Sweden is one of the largest forest owners and landowners in Sweden. So there's quite a lot of resources and assets within the church. So, but if we focus on the financial assets, we have at the national level close to we have 10 billion Swedish kronors, which is it's around 1.5 billion Canadian or $1.2 US. We have we work with we have different asset classes. We invest in both domestic equity, global equity, emerging markets equity, fixed income, real estate, and also alternative investments. And for the moment, we have roughly 55% of our assets in equity, mainly in global equity. I will come back a little more regarding the alternative investments later on. I think that's where we have where we have seen opportunities for impact investing a great deal. The financial goal we have is it's a long-term goal for the church. It's a 3% above inflation annually over 10 years. And I'm happy to say that we have managed to outperform that quite substantially. During up till the end of last year, we had an annual return of 8.5% over the last 10 years, compared to our benchmark then, our target that was 4.1. So we actually doubled that return. We use external managers only. We have done that. I started in 2005, and it was about that time that we moved over to just using external managers. And as of since last year now, we have only investing funds. So we have taken away or got rid of all the segregated mandates. And the reason for that is that it's become so much easier. There's so many options today with funds and asset managers that really have a focus on sustainability, which was not the case back in 2005 for sure. And one last thing maybe to take up here is that we apply sustainability in all of our asset classes. It's not a theme. It's nothing like that. We try to do it in across all asset classes, but of course you would do it differently depending on what the assets are. And I think this year the return has been, I guess it's the same thing in Canada and elsewhere. It was really a tough spring. March, I think we lost more than 20% of the fund, and we're back now, and I think by the end of it, we're sitting now at close to the end of November. I think we're about 3% for the year. So that's a bit of a background. Yeah.
Great, thank you, Anders. That's really helpful. And so there is quite a bit of alignment with those on the call, certainly in the use entirely of external asset managers. So that's something that the majority of the folks on the call will be familiar with. Thank you so much for sharing some of the documentation on your sustainable investing reports, and I'm sure we can share the link to those for everyone here. But in the report, it states that the goal of the Church of Sweden is to be a responsible owner in as diverse a manner as possible. And as we saw in the poll that was just done before we started here, that there's quite a range of strategies that folks on the call are using. The vast majority, 78% in screening, 72% in ESG integration, 59% in shareholder engagement, and a smaller amount, just 41% of those on the call doing the thematic investing. Can you talk a little bit for us just about the evolution of the Church of Sweden's responsible investment approach? And what are some of the diverse range of strategies that you employ in terms of asset selection and stewardship, and some of those strategies that we saw there on the screen? If you can just talk us a little bit through your journey. I mean, you said at this point you're sort of integrating ESG and sustainability across your asset classes, but how did you get there?
Yeah, thank you. That's a good question. Sure. I joined the church in 2005, and so my sort of perspective starts there. And I know that already in 2004, the church had signed up with, I think, was probably the only asset manager at that time that was able to integrate sustainability issues or responsible investment issues with the financial analysis. But if you look, I think we have done what most of the market and most of what has happened around the world. If you take sustainability back in 2005 or 2008 or 2009, whatever, it was only about exclusions, exclusion criteria, excluding sectors or companies. And today, no, it is so much about, as we heard today, there's so much about ESG, about impact investing. So that's been really a game changer in evolution. And I think when it comes to the financial side of it, when we started, for instance, to sell off our coal and oil, but also when we were considering sustainability factors, it was considered, I think, generally that this would be a financial trade-off. So the question was certainly from the U.S. side, not maybe so much in Europe, but certainly in the U.S. the issue was always, this looks good. It's good you do this, but what is the trade-off? How much do you have to pay in extra additional taxes or whatever to have this sustainable return? Today, I mean, it's the opposite. Today, I think most people would argue that, or most organizations, institutional investors would argue that sustainability is prerequisite actually for achieving a stable, long-term, good financial return. So I think that's completely changed. And I think that's true on both sides of the Atlantic. And when we divested from coal and oil back in 2008, that was viewed certainly as an additional huge risk to take. But today, I mean, this is mainstream amongst at least institutional asset owners, large pension funds and so that, to exclude oil and coal. And at that time, we did actually do some backtracking we didn't do this just blindfolded, to say. We did some serious research on this and found out that, well, this will not really change the risk that much. And I know also CalPERS, or maybe it might have been CalSTRS, but I think it was CalPERS that did some research also on this and actually followed different indices, including or excluding fossil fuels. And if you go back some 15 years or so, I mean, it's not a huge difference really. Well, it wasn't until a few years back. Now it's probably you will have a better return excluding fossil fuels.
Absolutely.
So that, I mean, that's for on the evolution. Yeah, absolutely. And I could also discuss a little bit on how we work with our asset managers.
That would be great.
So for us, it's important. I mean, it's really the essence of what we do is to identify the asset managers that really can make a difference. And in this case, I mean that we can identify the ones, and we were lucky already some 10 years ago with this, that identified asset managers that truly understand ESG, and they are really experts in integrating ESG factors in the financial analysis and in the investment decision. And we don't need to sign any huge documents with them for them to sign up that they have our policy and so on. It's for us, it's more important that we are aligned, we share the same values. So it's a lot about understanding each other and having faith in each other. So that's an important factor. And of course, sustainability as such must be something in the asset manager's DNA. That's usually what I refer to. So
yeah, I thought that was really interesting when we spoke earlier, when you said that you were really looking for managers who had this in their DNA and shared their values, as opposed to, oh, we have this one product over here and we do ESG integration there, but actually the rest of the company doesn't partake in that. And so can you just talk about why you think that's important?
Yeah, I think, as I also remember some instances where we've been approached by other asset managers, and they sort of have, we have this theme here, and we have this feel good factor and this overlay, so you can make your also investments sustainable. And if you hear something like that, then you say, hey, that's not really the way. No, we want it. The best thing is, I think, is if the managers, if this is the only thing they do, actually.
Yeah.
It can still be part maybe of a large organization, but I mean the whole team must be involved in this, and look at and view the investments from both a financial and sustainable approach. And it's very much about of course, identifying risks. And I mean that this is where it starts, because if you identify the risk, you will will be, of course, good for your return in the long run. That you will it will be more of a stable return. But I think what is also important if you want to have a really good return, financial return, is that the managers are available, or that they can also identify opportunities. It could be new markets, products, services, and so on, especially when it comes to the developing world, which doesn't mean that it has to be in emerging markets. It still can be in the global equity space. So that's important. What's also very important is that they understand the companies, that they understand the management, and that they are really they understand the strong management, and that there are not that many, and also that there are focused on the companies that they know. So that's why we think it's for us, it's been a better way to, a good way to, is to work with managers that have a concentrated portfolio, because they know the companies, and that is, I mean, that's proven for us to be very good. And when it comes to company management, to understand them, I mean, I think you heard the phrase that culture eats strategies for lunch. I mean, there can be so many strategies, but I mean, but the corporate culture, that's very important, and it's important for our managers to understand. Absolutely. So, and also, I mean, what I want to say, we can add here is that, of course, today you have a lot of information about, a lot of scoring about ESG and so on. But strong ESG scoring doesn't really guarantee that you have a good performance. There's usually quite a correlation between good ESG scoring and large companies and the size of companies. So if you rely too much on that, you might end up with a portfolio with only large companies and miss out on the sort of the extra return that the middle-sized or small cap companies can give you. Yeah.
The opportunities there. And in that sense, can you talk a little bit about the stewardship side of your strategies before we move on to talk a little bit about your own milestones, and just give us a sense of the role that either engagement or proxy voting play in your overall approach to sustainable investing?
Yeah, it's like I said, we don't ask our managers to sort of sign our policy or anything like that, but it's important that we share the same values, and since the fund usually is quite concentrated, we do not expect any companies that wouldn't follow our investment portfolio. Of course, we have also negative terms and negative screening. We apply that, but since there are so few companies, there are not very large incidents in this. But we have had cases where we have, and what we do in Sweden mainly, that there if we have some instances, we will work either to ourselves or with other investors to it could be issues like human resources, whatever that we need to engage with, but there are different forms for this also internationally. But since again, I mean, since we don't have that many instances, since we don't have that many companies in our portfolios.
Right. So I want to move on to just the theme of the session, which is around setting milestones, really as a way to mark our progress in terms of whether or not our responsible investing efforts are actually contributing to a more sustainable future. And I know the Church of Sweden has set targets, for example, related to the Paris-aligned investing. Members of your team have made contributions to the human rights benchmarks, and you're also active in the Swedish Investors for Sustainable Development. So you spoke briefly there about collaboration. Can you just tell us a bit more, perhaps specifically, about the work that you've been doing around the Paris-aligned investing, what some of the milestones you've set around climate change and divestment and what you're doing in that area?
Yeah, sure. I can just go back, I think, a little bit on sort of our milestones, what we've done throughout the years, or what have been sort of milestones for us also internally. As I said, we invested with the for 2004 with sustainable asset management in Zurich, which was the first manager that was able to include ESG. It wasn't called ESG at that time, but sustainability in the strategy. And in 2000, and we shifted also in 2006. I think we shifted from having a sort of a focus on exclusions to look more on the positive side, on a positive selection. We signed with the PRI in 2007, and in 2009 already, that's when we divested from coal and oil, which I told about earlier on. And in 2013, that's when we introduced the alternative investments. And that's where we have sort of identified an area where we can do, or we can have more of an impact, direct impact compared to listed equity. So alternative investments for us is where all the non-listed, all the private equity, where we find those investments. And one thing I would like to point out there is one area is the microfinancing investments that we've been doing. It's like I would call it a low-hanging fruit when it comes to impact investing. Mm-hmm. We have what you do is we invest with investment, or we lend money to banks in the developing world, and they will in return lend to small companies or individuals, women to a large extent. And this is really for the empowerment of small business and in the local societies. So that's what we've been identifying, so it's gradually we've been doing more and more sort of impact. And you mentioned this Swedish Investors for Sustainable Development. That's something that was initiated by the Swedish Development Aid, SIDA, and it has now also been moved or scaled up to a global investment sustainable development by the UN.
So Anders, we're just coming up to our time is up. So what I'm going to do is I'm going to share the Sustainable Investing Report, which outlines some of those impact investments, which are great. There's 3 or 4 listed there. Some are climate related, some are the microfinance initiative, as you talked, so people can dig into those a bit here. But unfortunately, we're at the 30 minutes past the hour. So I am going to have to turn it back to Mitchell, but I really want to thank you, Anders, for sharing in a short time frame part of the journey and the experience of the Church of Sweden. I think is very, very helpful to the audience. So thank you for taking the time and sharing that with us. And Mitchell, I will pass it back to you.
Thank you so much, Shannon. And thank you, everyone. Thank you, Anders, for insights from the Church of Sweden's journey that I think we all can learn from. And thank you again to Jerome, Sarah, and Emilie for our wonderful panel. I learned a lot today. And I also just want to give a thank you to the people we didn't see, to Damon Vanderlind, who did a lot of the tech, and for Amor Furteflor, who did a lot of the logistics. So many great people who made today possible. And thank you to all of you who came. And just a reminder, there's one more workshop in this series, and you can email info@share.ca for more information. You'll receive an evaluation questionnaire shortly. And please fill that out so we can learn and adapt to continue to do a great job of this. So thank you, everyone. I learned a lot today, and I hope you did too. Have a wonderful day. Grace and peace be with you all.